Hi, I'm Evan Weinberger. I'm a correspondent with Bloomberg Law. I've probably spoken to about half of everybody in this room at some point or another, so nice to see you. We're going to talk about shaking it off, how to bring more trust and safety into the fintech's ecosystem. I'll let my panelists introduce themselves. Go ahead, Matt.
Great. Thank you. I'm Matt Michaelis, Chairman and CEO of Emprise Bank out of Wichita, Kansas.
Hi, everyone. I'm Laura Kornhauser, co-founder and CEO of Stratyfy. We work with financial institutions to help improve their credit and risk-based decisions. Decisions like who to lend to, what to investigate for fraud. When we say improve, we say make them more efficient, make them more fair, and of course, make them more profitable.
Hi, everyone. I'm Itai Damti, co-founder and CEO at Unit. Unit is a financial infrastructure company that powers embedded finance relationships. We work with a large number of banks. Some of them are in this room, and we provide technology and services to them that allow them to enter direct relationships with tech companies. Over our 7 bank relationships, we help power more than 1.6 million end-user relationships through companies like Wix, Honeybook, Bill.com, and others. And I have to say, this is probably my 5th time in DC this year. When we started the company 5 years ago, I had no idea how important policy was going to be in the ultimate trajectory of our ecosystem. And I want to thank Phil and the team at AFC for doing so much important advocacy and helping people feel heard in this ecosystem.
And I'm Christian Widhalm. I'm CEO of Bloom Credit. We're a B2B credit data infrastructure platform, basically modernizing the rails for credit data transmission for today's and tomorrow's needs.
Okay, so we've seen the Synapse situation. We've seen some other concerns about fintechs and the way they market themselves to consumers and whether consumers understand what's happening, and also whether some of the banks that are partnering with fintechs are able to handle these relationships. So all of you form different parts of this ecosystem. All of you have services that are intended to help make the ecosystem work better. How do we do that? Matt, you want to start?
That's a big question. Well, I think the place where I would start is as a chartered institution, right? As the bank that underpins this, ultimately we have to recognize that we own the output, right? Regardless of our partners, regardless of the structures that we use, we at the end of the day own the output of the entire stack or the entire kind of product suite.
Okay, and Laura, by the way, congratulations on your award earlier today. But
Thank you.
AI is going to play a role in this. Yeah. It can sort of help make a lot of the back office processes that are really important work better. So where do you see your role? How does AI really going to shape this?
Yeah, absolutely. There is so much value that AI can deliver to the financial services ecosystem that has not been realized yet. And from our standpoint at Stratyfy, we're focused on what is often referred to as the more old school method, old school techniques in AI, more specifically machine learning. And we're at the forefront of what is called interpretable machine learning within that space. So what we really think is extraordinarily important in delivering that value or that promise of AI in financial services is something that a few folks have brought up today, is really that trust in the system and that trust in the way the system is working and the outputs therefore generated by the system, so that you can extract the operational efficiencies or the improvements in ROI that you're looking for. That trust piece is so darn key. And the only way that you can deliver that trust is via a level of transparency that allows folks that are not terribly familiar or subject matter experts in AI, allows still those folks to be part of that process and part of that system. So I think that's absolutely paramount to this next wave that we're going to be in with AI and financial services, really bringing folks around the table with different backgrounds and subject matter focuses that can still understand how and what the AI is doing for you and for your business. Then we can unlock a lot of the promise and the value that so many in the more tech side of the house have been kind of talking about for a long time now.
Right.
Yeah.
And Itai, so you and I have spoken before, post-Synapse, about the sort of how you provide a platform for smaller banks that might not have the compliance staff to be able to onboard customers, to have deposits, to maintain the ledgers, things of that nature. Where does Unit come in? How do you see this developing?
So I want to support what Matt said, that the ultimate owner of all financial services provided is the bank. And banks have no substitute for a very, very strong compliance team, especially in the space of embedded finance. I think one of the main problems we solve is how do you centralize relationships across multiple tech companies into one operating system. If you look at how companies like Chime and Venmo and Lending Club and others were built over the years, it was a lot of different systems of record and different identification practices or maybe statement generation practices, basically conducted and built by different kinds of systems and companies, and banks had to oversee all these practices across all of their programs. Unit is trying to help banks modernize and centralize those practices so that there is no divergence between different programs. So if a point-of-sale company like Toast or an e-commerce business like Shopify provides bank accounts to the end users, we basically maintain that all the identity processes needs to be the same, all the statements need to be the same, everything flows into one system of record, which is the Unit core. And this is our contribution, just the ability to centralize and allow banks to see the entire picture in one place.
Okay, and Christian, one of the promises of fintech is getting credit to people who would normally have a much more difficult time getting it. How do you do that safely and getting people credit that they can afford that isn't going to put them in the hole?
Yeah, it's a great question, and I think that one of the things that you need to understand is that the infrastructure that was kind of available today within the ecosystem was really kind of built more for traditional types of products and services that have kind of been normal for so many years. And now you've got a influx of different types of credit products that are kind of changing the way that consumers are behaving with credit products to some extent, things like BNPL and other types of things that are kind of now available. But the reality is when you kind of boil it down to accessibility to credit, there was a big push for the underbanked, but now there's a lot of folks that will say are under credit, right? About 100 million consumers in the United States don't have access to mainstream credit rates or products. That's 40% of the credit eligible population in the United States, folks that are over the age of 18. About half those have subprime credit. The other half are thin file, no file, unscorable, limited credit history. Could be folks that are younger, early on in their borrowing years, could be immigrants with limited credit history in this country. And I think that the key to really kind of unlocking that is to try to create ways that consumers can better demonstrate, these underserved consumers will say, can better demonstrate credit risk without necessarily going into debt. There's all sorts of different types of data that's out there, whether it's coming from checking accounts or otherwise, that can actually provide more insights into these potential consumers. And I think that like the power and promise of fintech, right, is how you actually collaborate with FIs and the incumbents, the credit bureaus, and everybody else that are obviously incredibly important to the underpinnings of the US financial system. But how do you actually help level up to provide more detail, more insight, to be able to say yes to more consumers, to be able to actually say yes to the right consumers, and to be able to account for credit risk appropriately? So I think that that's the big step. And then after that, there's another hurdle, which is the adoption of that data by the larger institutions that I think deservingly should probably tread slowly when they're actually looking at these new types of data as compared to what they've looked at with their traditional credit risk models in the past. I think it'll take them some time, but I think a lot of this that's emerging now will become more mainstream and critical to helping expand access to affordable credit.
So this is a question for everyone. I'd love to hear you all weigh in. How do you make some of these things more mainstream? We've been hearing about alternative credit scoring for a while now. AI has been around for a while now, and it always seems like there's pushback from regulators. Some banks might not feel totally comfortable with these things. How do you get, as a bank, how do you get comfortable with it? And as a fintech, how do you work to make it a product that people can use? Let's start with Laura.
Yeah, I'm happy to start on the fintech side on making it a product you can use. I mean, this is again where we have to get the barriers that have been keeping it from being more widely adopted. We've got to bring those barriers down. So one of the barriers has been talent. and access to talent. So we need to have more systems that can be leveraged by folks that are not data scientists, and can be effectively and safely and responsibly used by subject matter experts and not just, again, data scientists. So that's one, is the talent kind of hurdle. Cost is another one. And there has been a lot of movement on the cost side in recent times, and particularly in the last, I'll call it year or so, there's been a lot of movement down in the cost side. Depending on what type of AI we're talking about here, we've got to really think about why that movement and cost is happening, and folks have to be really thoughtful about, is the cost low just because you're subsidizing data capture and data gathering on the part of another company? Or is the cost low for more sustainable and meaningful reasons? But that's a big piece of it as well. And then I think that the technology has needed to evolve to a place where these you can have that greater level of accessibility for folks. And again, we feel strongly that that's related to the transparency aspect embedded in a lot of AI and machine learning use cases and technologies. Those have been the biggest barriers to adoption that we have seen. And then people like to throw on top of that blanket of regulatory uncertainty and risk. But a lot of that is coming from a lack of advancement in the technology, and the technology being built for purpose in financial services versus built in other industries and brought over to financial service. And that all has changed in recent times. You have folks that have now built AI that is built for financial services and built for the very specific constraints and situations that exist for good reason within the financial services industry.
Right. I'm just curious, like with the rise of Gen AI,
Yeah.
which is a different thing than what you do.
Yeah.
When you go in and talk to the banks, do they kind of get the difference, or do you spend a lot of time trying
No.
to explain what's going on?
Do not get the difference whatsoever. AI is this like big thing, big magic shiny thing. And our company is about 7.5 years old, and even in the very early days, like we used to joke about, oh, let's just sprinkle some AI on that, and then all of a sudden you're gonna achieve some bliss, and nothing is more certain, like nothing is more real than that in the last, call it year to 18 months. So we actually think it's very important when speaking about AI or when talking to customers to be really, really deliberate about, what you hear out there in the media as referenced as AI is one subfield, one section of AI. What we're doing is different. It is not so novel that it needs to be scary. It has been used, it has proved value, it has gone through cycles, it has done all of those things. So one does not have to be as fearful about every kind of AI as I think one should be about certain use cases within Gen AI.
Well, I might share a bank's
Yeah.
perspective. Look, we're eager to, and we have a team of data scientists that we use it as much as we can and in places where we can. What I would say, though, is I would go back to your regulatory comment, right? I think we understand the places we can go deploy it. The regulators aren't always comfortable around that, and we heard some of that earlier today from a guest or two. I'm a huge proponent of their ability to create sandboxes or understand our use of sandboxes in deploying some of that technology, so we can actually prove it out in, with our customer base, with our teams, wherever we may want to go deploy it, and then we can demonstrate that it works. That it works well, that it's even more effective than how we may do it today, and realize those benefits, and then deploy it more broadly than that. That's where I see some of the constraints, in addition to the other things that you mentioned.
I think that, I think that we live in a financial world that we've lived in for a long time, that a lot of the data has been there and it's been standardized for a long period of time, where there's been the ability for people to create credit risk models as well as the major scoring models like FICO and Vantage. All that stuff has been back tested, different vintages and cohorts and whatnot, in order to get people comfortable with the credit risk behind it. And I think that as more alternative data and more different types of data are potentially able to be brought in, to me, the biggest thing is to standardize it, right? Because if stuff can't be standardized and brought en masse, then there's no way for people to actually start backtesting it to have confidence in models and making credit risk decisions. And I think that is like the real like big first line. I think AI helps there, or can help there a lot. But I think that's critical in order to start getting more alternative data in. You need more data standardized in a way for people to backtest it to confidently make decisions.
And Itai, obviously over the last couple of months, the concept of sort of these middleware providers has become, I don't know, controversial at some of the bank regulators, but also just complicated given what's happened.
Mm-hmm.
How do you sell yourself to banks, and how do you differentiate what Unit does with what's been done in the past that regulators have looked askance
I think
at?
the model definitely evolved over the years. I would say that today it's becoming very clear that there is a regulatory expectations that banks are in direct touch with all of their programs. They sign and perform due diligence on all of their programs. So if a company like Amazon or Etsy wanted to work with a bank to deliver charge cards or bank accounts built into their experience, the bank is then expected to know them. They're expected to understand their fee structure, their identification structure, how they provide business continuity to these businesses in the case that there's any disruption, how do they distribute statements, etc. So we are strongly in the camp that banks now need a place to stand up all these relationships and oversee them and make them more consistent. So from our perspective, it's different from a set of other models that you see in the industry. I think Synapse was one example for a company that basically tried to get a license, a broker-dealer license in their case, and truly stand between the bank and all of the programs that they serve. In many cases, the bank did not even know the names or the practices of these programs. So I think it's really important to take the control all the way back to the banks, give them one operating system, almost like a core system, that allows them to develop and manage all of these relationships and do it in a centralized and tracked way. This is not 100% of the practices in the market today, but this is something we believe is very, very important.
Matt, how has the way that you have looked at fintech partnerships evolved over the years?
So I think about, one, I'd take a step back and just say partnerships are incredibly important to us. We can't build a business without it. And I would say that's true in our traditional business as well, right? And Itai, you referenced the core system. I mean, it's not like we've built our own ledger for our traditional bank and now somehow are doing something different for our embedded banking business. We've selected different partners for that with different capabilities, but we still use a partnership model that is so critical. And you know, as I was saying earlier, and you still have to recognize at the end of the day, you own that end customer and their experience and what that looks and feels like. But the partnerships are critical for us to be able to do that well.
Mm-hmm. Are you asking more from your partners about like how they do their business, how they do their ledgering, things of that nature now than you might have in the past?
I would say we've always had a pretty elevated level of asking questions, but yes, there is a higher level of diligence around our partnerships and the programs that we launch on top of them. I think there has to be. I think we've all probably seen that evolution, but I also think it's the right way for us to do it. Knowing, again, I hate to feel like I'm beating on the same drum, but knowing that we're ultimately responsible in the regulator's eyes, we have to know, we have to have more information around those programs and customers.
So one of the ideas that Chairman McWilliams brought up during her talk here was the FDIC was developing sort of a good housekeeping seal of approval for fintechs that could, a private institution could sort of set up a certification, and also that's something that the CFPB considered in its 1033 rule. Is that something that would help sort of standardize the environment, make it a safer environment for banks, for fintechs, and for the customers?
I mean, I'll take a stab at that and say I think there are a number of ways that we can help, I'll say, raise the bar for the industry. I think that is certainly one that could work. we talk a lot about standards, and there have been a number of conversations around that today. I think education goes hand in hand with that, right? And as some of the shortcomings that we see in the broader regulatory environment is just an awareness of familiarity, a level of education around what we're trying to do. So I think that's a meaningful component that we'd like to continue to work on with the teams. But I think there are a lot of ways that we can continue to make it a safer environment.
Christian, what do you think about private standard setting like that?
Look, I think that, and I think ultimately, like banking as a service in general, the concept and the opportunity is tremendous, right? And I think that it's something that benefits obviously the end consumer by having innovative products brought to market that actually serve their needs in a variety of ways. It also helps banks very much compete as well as leverage their expertise, their deep expertise in regulatory compliance and infrastructure around bringing financial services products to market incredibly well. And I think that ultimately what we've kind of seen, and someone mentioned it earlier in one of the earlier things on EWA, but look at like it's going through like a maturation process. If you look at like Uber and the rideshare industry when it first started, it was kind of the Wild West. Like, you had drivers that weren't insured. You had folks that weren't going through proper safety inspections on like vehicles. People weren't licensed. Municipalities were like going back and forth on letting people into airports that had rides. It was kind of a mess, right? But it started going through. They started actually going and putting some regulation at the local level as well as I think at the higher levels around it. And ultimately, can you imagine a world without having rideshare and all the other services that actually come with it? And I believe firmly that BaaS is in this exact phase right now. It is going to come out way better, way stronger, and I think it's going to serve everybody better because I think that the banks will be more, to all the things that have been said, that the banks will be more on top of it through regulation compliance. I think that the better partners, Unit and others that are out there will be the ones that rise to the top to be able to help serve this industry and move it forward. And I honestly have really high and exciting hopes for the future of BaaS in this next phase that it needs to go, or it's going to go through.
I strongly agree with the Uber sentiment. I think if you look at the problem of transportation, it's a very old problem. We've faced this as civilization for tens of thousands of years. And Uber had a different take that allowed this to be solved at a greater scale and level of efficiency. And yes, they disrupted ecosystems. And I think that the problem of embedded financial services is the same problem. Financial services, the storage, the movement of money, the extension of credit is an old problem. It's also been in solution mode for hundreds of years. And there is a class of companies here that try to embed those financial services. They're not new, right? Storing and moving money is the same thing whether you go to a JP Morgan branch or you use Toast. And but the way they're trying to do this, I think, has put some questions in this ecosystem that over time will be solved, organized, and the right practices will float. I think there has been a lot of fear of any form of innovation, and there's a mysticism around embedded finance, which I think we need to deal with if we just analyze how it's actually being done.
Laura, any thoughts on the sort of setting standards, particularly for AI? Because I think the current administration is trying to figure it out, and the next one is going to have to figure it out. So how do you see that playing out?
Yeah, we're going to see some changes on the regulatory front. That is for sure. Me personally, I expect that we are going to see a lot of regulation move to state level. So we're going to have that kind of decentralization around regulation in AI, and then certain states are going to be more aggressive, others will be more conservative. I think the other thing that we're going to see is the private sector really stepping up, and you're going to see companies, putting pen to paper if they haven't already around what fair and responsible use of AI means to them, and what are their guidelines that they will follow internally in order to deliver on that. So I think that a lot of the regulation that the Biden administration had been pushing through via AI executive order and others will now kind of, again, fall back a little bit more into the states and a bit more into corporations to make some of those determinations themselves. I don't think regulation of AI is going away, nor should it. But I think that there could be a really interesting period ahead of us where folks do feel a little bit more comfortable making those decisions for themselves and for their organizations, and through the use of things like sandboxes that I think will come back a lot more than they have been around recently. We could see some really interesting new use cases get pushed out because there's a bit less fear of regulation via enforcement coming to get you. And I think that would be a really exciting kind of age that we would be stepping into here. But I think it's extraordinarily important for us to also recognize that this technology can't just kind of go off unchecked and not have the right watchful eyes over it. But I don't personally think that's going to happen in financial services. Like, this is not an industry in which, the masses at least tend to do that. There will be a few people out there that do things irresponsibly and likely lose a lot of investor and unfortunately consumer money in the process, because people, if people go with those high flyers, there are risks associated. But I don't see kind of the masses of the industry moving towards the dark zone of AI anytime soon.
Right, and just really curious about standard setting, because again, it's something we've talked about a lot. Is there a danger that having sort of industry standards set up kind of lessens the innovation, and if we're too prescriptive, and if there's kind of a herding of technology?
Yeah, so this is the constant debate of, okay, if we set standards, is that then therefore too prescriptive, and then therefore we stifle innovation? I think we definitely have more movement we can make towards greater transparency and visibility of what the regs are and what the standards are. And we are not anywhere close to the stifling innovation level of prescriptiveness where we are right now. We would have to move a lot further to get towards that being a real fear and real risk, in my personal opinion. Right now, there is just a little too much unknown out there about what folks should be doing. Like, an area that is very near and dear to our heart, for example, is fair lending compliance. There is very clear rules and regs around fair lending compliance, but there is not a whole lot of clarity around LDA searches, less discriminatory alternatives. What is the process that should be employed for when you search for these? What then do you have to do to justify that search was robust enough and reached an answer? Like, there is a lot of opaqueness out here. There's been some great work being done by industry to try to push that forward. Shout out to NCRC for really spearheading a letter that we sent to the CFPB over the summer on this topic in particular. So, like, these areas, we can get a lot more clarity that will be good for our financial system, good for our economy, good for consumer, and will not stifle innovation at all.
Matt, it looked like you had something you wanted to say.
I was just going to put an exclamation mark around that. I feel the same way. I mean, the regulating through enforcement action is just not particularly helpful, and it's a little fear-inducing. I think to the extent that we have some more rules of the road, it would help all of us accelerate around innovation. Your point's well made. You can get too prescriptive, but we are far away.
So Matt and I, before we came on, were discussing the sort of regulatory pendulum as we await to see who's going to be running the federal agencies. How do you, when you're running your businesses, how do you plan around that, and how do you kind of figure out how you're going to operate over the next few years?
Well, I guess I would take a step back and say that there's a lot of value to predictability, and I think what you and I were kind of talking about is, when we entered this business, we weren't entering it for 2 years or 4 years. We weren't entering it for just an election cycle. It's something that you invest in for years and then hope to see benefit for years thereafter. And so there's real value in predictability. Clearly, we don't have that in today's environment, and so you adjust as best you can. Now, that being said, I'm glad we have we're state chartered, so we're also, the FDIC rides sidecar with us, so I'm encouraged about some of the developments today. But overall, with that predictability, I think Phil and others have said, making change that's sustainable and long-lasting, that resonates with me. That's important as we think about building our business.
Okay, we are almost out of time. So let's say we're back here in the end of the 4 years, the end of the Trump administration, or 5 years from now, what do you expect the state of bank partnerships to be, and how are you building the trust in those situations? Itai, you go first. You haven't gone first yet.
I think much better standards both from the agencies and the industry. So it will be clear what a clean consumer program looks like, what a clean business banking program looks like, what credit looks like for those different types of audiences. And I think the growth among infrastructure companies and the programs that use them to work with banks is going to be significant. That's, of course, our hope.
Anybody else?
I'll jump in. I mean, bank and fintech partnerships are absolutely crucial, critical to the success of the bank. So I think in, call it 4 or 5 years, if we're here, any banks that are not partnered with fintechs will not be around anymore. Like, I think it is that critical, it is that existential, it is a crisis of, are you going to continue to survive? And the ones that push forward with responsible innovation and do so with one that is a longer vision of that innovation beyond any given administration are going to be the ones that are succeeding, and the ones that don't do it won't be around anymore.
All right. And with that, unfortunately, we are out of time. So can you all thank Christian and Itai and Matt and Laura for their time today?